Did you know that order blocks, mitigation blocks, and breaker blocks are essentially the exact same thing? They are fair value areas. And today you are going to learn which fair value areas are the best to trade from. Now, before we dive into that, the first link in the description, there's a study notion that you can use completely for free. And that will help you taking notes for this video, but also doing case studies so you can fully understand it. All right. So in the 7th video of the MMC series, we are going to dive into fair value areas. So we understand the direction, but now we are discussing narrative. So if we are going higher, then where are we going higher from? And one of those areas is the overlapping defense. Like we mentioned, if we break down that order flow lag, it is the first area we retrace back into where two PD rays are overlapping. Ideally, we want the overlapping defense to be a fair value area and the first line of defense to be a fair value gap. If we create a scenario where the overlapping defense becomes the fair value gap and the first line of defense is actually the fair value area, that is not high probability. That is not a good order flow lag. Now, if this is not familiar to you, after watching this video, you can rewatch the previous MMC series videos where we go over overlapping defense and narrative, everything you need to know beforehand. So we're going to learn how to differentiate a good fair value area from a bad fair value area. And if we can trade back into the fair value area or only into the fair value gap. But before we do that, we need to understand where these fair value areas are created. Fair value areas get created when taking out previous swing points. When I talk about swing points in this context, price action is going to take out swing highs and swing lows, so short-term highs and short-term lows, but also intermediate-term highs and intermediate-term lows, which will look something like this. At the top, let's assume that that is an intermediate-term high. And that intermediate-term high is our main target. So that is what we can trade towards. And we see price is continuing higher. Now we also see that towards the left right here, it has taken this short-term high and also this short-term high right there. Those short-term highs turn into fair value areas. And those fair value areas is what we can continue higher from right there until we reach the intermediate term high. Once we reach the intermediate term high, that also turns into a fair value area. Now, here we are on Australian dollar, New Zealand dollar on the daily time frame. Let's first again revisit the fair value areas, what kind of fair value areas we had. They are all part of that 3 swing movement. Now, one type of fair value area that we have is this fair value area right here, where we, first of all, continue higher, make the move higher. That is the buy side again. Then we have the sell side. And afterwards, we have again the buy side. So this whole area right here is fair value. And that means that the only area that's not fair value is above the fair value area right there. This small movement above the high that we just took. And if the market is going to offer fair value again, the furthest it can retrace is to the fair value area to then continue higher. Because everything below is already fair value. So it has no reason to create a very deep retracement. And if it does create a very deep retracement, then the market is most likely not offering fair value. No, it is seeking liquidity. Because the market is always either offering fair value or it is seeking liquidity. Now, this is something we've already gone over. So we have this fair value area right there, and we also have this fair value area right here based on intermediate term highs. Then we also discussed that we have those fair value areas based on short-term highs. So the exact same, just based on short-term highs and short-term lows. This was discussed in the 2nd video about market structure and fair value areas. What does this look like in a chart and how can we use this? On the daily time frame right here, we can see that we create a movement higher, all the way higher towards this intermediate term high towards the left right there. Now, on the way towards that intermediate term high, we will also see fair value areas getting created. For example, this on the left side right here is a fair value area. It's the first example that we just showed. If we go down time frames into the 4 hour, for example, we'll see even more fair value areas. So for example, this right here is also a fair value area. Then when we continue higher, we have more and more fair value areas. So we have this fair value area. We also have this fair value area sitting right there. It is the constant retracement that we create before we continue higher. And then afterwards, our target in the form of this intermediate term high right there has been reached. Now, when that target in the form of an intermediate term high has been reached, we create a new fair value area, because this high right there is the new fair value area sitting right here. And if we want to continue higher, then the current retracement that we see could be a retracement to offer fair value to continue higher. But that's not always the case, because we could also disrespect the fair value area to then continue lower instead. And that is also something that we are going to discuss. So going back to the PowerPoint, those fair value areas again form when we take out previous swing points. The previous target that we had actually turns into a fair value area. Now, there is different types of fair value areas, because we have good fair value areas, but also bad fair value areas. Now, the first thing to understand is that this is based on strength again. We have different types of fair value areas. The exact same as what we discussed in the fair value gap video, the previous video, where the type of fair value gap that we have is going to be determined by the strength that we have in the market. Now, we're going to rank them again from best to worst, where the best type of fair value area is a fair value area with an overlapping fair value gap plus a nested fair value area. So what does that look like? Well, the overlapping fair value gap right here is overlapping with the exact swing point that we took to the left. So when we take out a swing point and we trade above a swing high, for example, if we want that to be a good fair value area, then we should create a fair value gap exactly overlapping with the high that we just took. Now, why is this? Because this shows a lot of strength in the market. Because if we don't create that fair value gap that is exactly overlapping with that fair value area, it's just weaker, because that fair value gap shows us the strength in the market. Then we also ideally want to see a nested fair value area. Now, what does that mean? Now, if we take a look at Australian dollar, New Zealand dollar, and we go into the 4-hour time frame, then on the 4-hour time frame, we have this fair value area that we have towards the left. Why is that again, that fair value area? On the daily, it was a short-term high. On the 4-hour, it's an intermediate-term high. That intermediate-term high turns into a fair value area as soon as we trade above it. The highest probability fair value area has this fair value gap on the right side overlapping with the exact high that we took right there. So on the 4-hour here, it checks both boxes. We have the fair value area and it's overlapping with a fair value gap. Now the third box is a nested fair value area. This fair value area that we have right here is the bigger fair value area. That's the intermediate term high that we took right there. In the last price movement, before we took out this high right there, we also see actually a smaller fair value area sitting right here, which is nested inside the bigger fair value area. Those nested fair value areas, you will find them just below the original fair value area sitting right there. Now, what price tends to do if it struggles with that first fair value area right there, and we create a bigger retracement, we could see a continuation higher potentially from the nested fair value area right there in combination with the fair value gap with the bigger fair value area as well. Now think about why this is. If we try to continue higher from a fair value gap alone, that's one discount array. If we combine a fair value gap with a fair value area like this, that is 2 discount arrays that we can potentially continue higher from. That's double the strength of only a fair value gap. If we then also have a nested fair value area sitting just below the original, the bigger fair value area, then that's 3 discount arrays. That is triple the strength of just one fair value gap. Like we mentioned in previous videos, trading is all about probabilities. So if you can multiply your probability by 3, then of course that is a lot higher probability. That is the ideal fair value area. Now, the second type of fair value area that we have, which I would argue is still a really good fair value area. Just because it's second does not mean it's necessarily a very bad fair value area. And that is without the nested fair value area, just a normal fair value area with an overlapping fair value gap. So here on one of the indices on Russell, we see that we have taken an intermediate term high towards the left right there. It is perfectly overlapping with the fair value gap towards the right. Just before we take out this intermediate term high towards the left, we don't have a nested fair value area sitting right here. But again, we do have a fair value gap overlapping exactly with the fair value area. And look at the accuracy for that fair value area right there. Indices are known for having really good accuracy as well. A perfect sting into it to then continue higher towards this high right there. Now we could argue that this high also turns into a fair value area, right? But is it a good fair value area? And that is exactly the last type of fair value area that we have to dive into, because that is the worst fair value area to trade from. When we create a fair value area, but we are sweeping a high, or if it's a bearish fair value area, the low, then that is not a good fair value area to trade from. This is exactly the case when the fair value area is the first line of defense and not the overlapping defense, where the fair value gap is the overlapping defense. Where when we trade above a swing point, so that swing high to the left, instead of creating an overlapping fair value gap on the right side that is perfectly overlapping with the high that we just took, we create that wick above it. Now, based on the previous video as well, what does that mean? That means that we are respecting that swing high that we just took. So a potential sweep of that swing high, which we're going to go over in the next video. So since we are respecting that swing high, also based on candle signs, it's a respect candle, that means there's also a lot of bearish strength in the market right there, where the fair value area actually turns into the first line of defense. And the fair value gap right there is the overlapping defense. And very logically, very simple, this just shows a lack of strength on the bullish side. And when that is the case and we want to see higher prices, of course, we ideally want price action to be as strong as possible for the bullish side if we want to see bullish prices. So this is one fair value area that you can just avoid at all times. If you see this, simply don't trade from it. This can either lead to lower prices, but most of the time this can also lead to a consolidation. And that's what I meant right here on Russell again. When we take out this high, we know that turns into an eventual fair value area. If we go into the 4-hour, for example, this high is the bigger fair value area. But with a sweep like this, of course, it's not that interesting to trade off the fair value area anymore. If we create a bearish fair value gap right here, then the fair value area low that we have towards the left might actually become the target. Now, this is also something that we're seeing on GBP Australian dollar. At first, we have this intermediate term high towards the left right there that we took. Perfectly fine, nothing wrong. We retrace back into it and we do respect it to potentially continue higher, creating a new target of this high right there. So if we go into the 4-hour, on the 4-hour, we see that we do have fair value gaps right there pushing higher. But the exact high that we just took is not overlapping with a fair value gap. This is the variable where we're a little bit in between, where we're not wicking that high, but we also don't have an overlapping fair value gap with that high. When this is the case, there's only one area that we can still continue higher from, and it is this fair value gap right there, and ideally very high. Only a sting into the fair value gap to then continue higher right there. So we're not creating a deep retracement into the fair value area. When we do create a very deep retracement like this, again, there's two options. Either this is going to consolidate to then still continue higher, or we will see lower prices and actually the fair value area low becomes the target right there. Now, a good example of this is currently Australian dollar, New Zealand dollar. This will be very interesting to see what it wants to do. We currently have a retracement into this bigger fair value area right here. This is where we can expect a rejection when we have a bullish rejection sitting right there. If we create also a bullish fair value gap, we might be looking at higher prices and targeting this high right there. So a new bullish order flow leg. But if we create somewhat of a rejection, but the rejection fails right there, and we create a new bearish fair value gap instead, that tells us that the fair value area is not strong enough, it is not offering fair value anymore, and it might actually be seeking liquidity in the form of these lows right here, the low of the fair value area. This is definitely one you want to add to your case study. Now, before we go over what the case study actually is, we also need to understand if we want to create a retracement into the fair value gap or into the fair value area. And let me start off by saying the following. In this example, we're going to assume that the first line of defense is the fair value gap. The overlapping defense is the fair value area, so the perfect order flow lag. In the scenario where the overlapping defense is the fair value gap and the first line of defense is a fair value area, then we would expect a retracement into the overlapping defense of the fair value gap. That fair value gap is the last area that we can still continue higher from or continue lower from. So what I mean by that is if we take this high to the left right there, we know that turns into a fair value area, but it doesn't have that overlapping fair value gap right there. So that means the fair value area is the first line of defense and the fair value gap is now the overlapping defense, which is sitting right here. When this is the case, if we still want to continue higher, we will continue higher off of this fair value gap right there. So that is the fair value gap that you would want to trade from. But you would want more confirmation, of course, because we are sweeping that high. If the rejection fails from that fair value gap and instead we create bearish fair value gaps, disrespecting, based on candle signs, that fair value gap, then we can look to target the low again of the fair value area instead. So if you write that down in your study notion, then that is a mechanical, an objective, step-by-step plan. All right, so that is when the first line of defense is again that fair value area. But let's assume the first line of defense is the fair value gap and the overlapping defense is the fair value area. Then, do we want to trade from the fair value gap or the fair value area? So where are we going to place our entry? But more importantly, where are we going to look for our entry confirmation if this is on the higher time frame? That depends on the following two things. The first one is, what is time telling us? What do I mean by that? Well, time is something we are going to go over not in the next video, but the one after that. So we'll dive into that in the time video. But to give you a sneak peek already, if we sting into the first line of defense alone and we don't have any time agreeing with the ID just yet, then there's no volatility just yet. So that means when the volatility does come in, we can expect a little bit of a deep retracement into the fair value area to then continue higher instead. Again, we'll dive deeper into that in the time video. Then the second thing is the following. Did we just take an intermediate term high or an intermediate term low? If that's the case, that of course turns into a fair value area. So then we can expect a bigger retracement back into the fair value area, back towards the intermediate term high or the intermediate term low that we just took. Now to fully understand this, let's dive into the chart. So on the examples that we have gone over thus far in this video, for example, Australian dollar, New Zealand dollar, we see that when we take this intermediate term high right here, this is when we can now expect a deeper retracement back into the fair value area high. And that is something that I would love for you to study. On the movement on the daily time frame right here, towards the intermediate term high, we create fair value gaps and we create barely any retracement right there. That is exactly what we would like to see until we reach the intermediate term high. This goes for any time frame. So for example, when we look to target an intermediate term high or an intermediate term low, in the move towards the intermediate term high or the intermediate term low, we expect fast price action. And again, why is that? That is because of the three swing movement again. So when we offer that buy side, at that moment in time, we have not offered sell side just yet. So we need to offer fair value right there to then continue higher. Now, once price is at this moment in time, then this high right there is the intermediate term high. When we create a fair value gap moving towards the intermediate term high, that's when we can expect new fair value gaps and fast price action and small retracements. Now, again, why is that? That is because this area right here, when it has already offered fair value, is now already fair value. That means that when price is continuing higher right here, it doesn't have anything to do anymore. It has no business to do there. And again, why? Because it has offered fair value, so it doesn't have to do anything anymore. So it can continue higher fast because it has already offered that fair value. Whereas if we now continue higher right there and we take out that intermediate term high, then there's an area right here where we have not offered fair value just yet. And that is above the intermediate term high. So that is where we can expect, again, quite slow price action, can mess around a little bit, can create a consolidation. We can sting into the fair value area. And on this right side, we can again expect fast price action with minimal retracements. Because the area from this high towards that previous intermediate high is now fair value area. So it doesn't have anything to do anymore. And if it does create a deep retracement, then what is it most likely doing? It is seeking liquidity right there. And that is the same that we can say about this move higher right here. Since this is already fair value, we have a fair value gap higher right there. We are not offering fair value anymore. So that intermediate high is what? That's liquidity. So the market is going to seek that fast. That is one of the many extremely advanced topics that we go over in the MMT. That gives you such a valuable skill, because when you know where those fair value gaps should form, how far we should retrace, then if the retracement is too big or we shouldn't create a retracement, then you also automatically know which conditions to avoid. And then you know what low probability conditions also are. Now that again is quite advanced. If you understand this, where we should ideally sting back into fair value gaps or create very small retracements, that is in the movement towards the intermediate high or the intermediate low. Goes for any time frame. So if you have a 1 minute intermediate high that you're targeting towards that 1 minute intermediate high, we expect fair value gaps to be created, fast price action with minimal retracement. So only retracements into those 1 minute fair value gaps. Now, of course, when we go into the lower time frame right here and we go into the 1 hour, for example, the move towards this daily intermediate high is where we'll see daily fair value gaps hold and only daily fair value gaps sting back into. But on the 1 hour, we have a lot more intermediate highs. So we can actually expect retracements back into fair value areas like this. By the way, with a nice nested fair value area sitting right there as well. But the same thing applies. So the same thing happens. When we continue higher off of this fair value area and we target this new intermediate high right there, fast price action happens. And notice where the breakaway gap is. If you understand that, you have an extremely advanced understanding. It's quite funny actually, because it goes extremely deep, but it's all based on the same logic that we use. So for Russell, for the indices right here, we see the same exact thing. Fast price action right there on the right side. And here we also see the retracement back into the intermediate high after we take it. For GBP Australian dollar, we also see the exact same thing again. Fast price action with minimal retracements, only retracements into ideally fair value gaps. After we take out the intermediate high, we can expect a bigger retracement, slower price action, so we can trade from the fair value area instead. Now, in every video, I ask you for a favor as well, because you will never truly understand concepts that we go over if you don't do a case study. First, link in the description for the study notion. The case study for this video is the following. Start studying when fair value areas get respected and when they get disrespected. So when do they actually hold and offer fair value to then continue higher or lower? Or when do we start seeking that liquidity? That will be very beneficial, because that is what we're going to base our trading plan around as well. So start studying when we offer that fair value and we simply continue higher or continue lower, respecting the fair value area, or not offering that fair value anymore. And instead we are disrespecting the fair value area to then seek liquidity as well. That will be very beneficial for the coming videos. All right, perfect. Thank you.